Exactly. So this piece is a high-momentum investment alert. It's focused on TerraWulf, the Wolf stock, and its recent breakout.
Right. And it attributes that surge to two things: a big capital structure cleanup and, a pretty smart pivot to AI infrastructure using nuclear power.
Exactly. So let's just jump right in. This analysis has a lot of good points, but to make it truly institutional grade, there are a few things to address.
I agree. Let's start with that capital structure cleanup.
The material argues, and I think correctly, that simplifying the books, getting rid of those Series A preferreds, is the main catalyst.
That's what opens the door to the big money, the institutional funds. But, and this is the first major point, the analysis of the mandatory conversion of Series A convertible preferred stock needs to fully contextualize the resulting share dilution for sophisticated institutional-minded investors.
Yes. The weakness here is pretty clear, isn't it? It frames the whole thing as a bullish event.
Which it is, in a way. Tidying up the balance sheet is always good.
But it completely skips over the other side of that coin. You convert preferred stock, you immediately get more common stock. A lot more.
And that's dilution. Plain and simple. For the kind of audiences is aimed at, professional investors, leaving that out feels, well, it feels like you're hiding something.
It just undermines the credibility of the whole piece. It suggests you're only willing to show the good parts.
Precisely. It comes across as cheerleading, not analysis. And these readers, they already know the math. They're going to see that gap in about 10 seconds flat.
So I guess the counter-argument could be, why spell it out? If they already know, isn't it just wasting space and maybe undermining the urgency of the alert?
I don't think so. Not if you frame it correctly. My suggestion is to tackle it head-on. Integrate a brief but very transparent discussion about the dilution right at the start.
So you present it as a calculated trade-off.
Exactly. You frame it as a necessary cost. Management is paying this price in dilution to get long-term stability and to get on the radar of those big funds. It's a strategic move.
Okay, so you turn what looks like a negative into a sign of confident, forward-thinking management.
That's the way to do it. You have to give some concrete examples. You could explicitly state that this conversion increases the common stock float.
And that this might create some short-term selling pressure.
Yes, or a temporary hit to the EPS, the earnings per share. You have to acknowledge that the math for a little while might look worse.
And then you immediately pivot.
You reframe the benefit. It's not just attracting index funds. It's something like management is prioritizing corporate maturity over minimizing the short-term share count.
Because they're confident that future growth will more than make up for it.
Yes, it shows they're playing the long game, that this dilution is an investment in becoming a serious index-eligible company by 2025 or 2026. That's how you build real conviction. It's what the target audience expects.
Okay, let's move to the second point, the price targets. They're calling for targets up to $26.
Which is a huge move from where it is now, a multi-bagger.
And when you're making a call that bold, you have to anticipate the pushback. Sophisticated investors, they're trained to look for the downside first.
And that's where I think the piece is a little thin right now. So here's the next point. To maximize the material's credibility and align with the expectations of sophisticated readers, the high conviction analysis must dedicate a clearly defined section to potential counter-arguments, risks, and challenges to achieving the ambitious price targets.
The weakness is just so obvious. When you put it like that, the tone is pure breakout alert. It's all excitement.
And the only thing that even looks like a warning is that little trader's view box.
Right, which is just technical analysis. Support at 1250, resistance at 1435, RSI momentum.
That's not risk analysis. That's just talking about short-term chart friction. If you're asking someone to believe in a $26 target, you need to talk about the real fundamental headwinds.
Otherwise, it just sounds speculative, like a hopeful guess.
Exactly. So the suggestion here is pretty straightforward. You need to add a dedicated section, call it execution risks and headwinds, something like that.
Something that signals to the reader that you've done the comprehensive due diligence.
Right. And you need to be specific. I see two key areas to cover. First is just pure execution risk.
Okay.
The financials mention $72.5 million in annual HPC hosting revenue. But that's expected once they're fully online in 2026.
That's a projection. It's not money in the bank today. And building out that kind of infrastructure, it's never a straight line.
Never. So you need to include a discussion about that. What's the risk of timeline slippage? What about permitting delays or supply chain issues for specialized hardware?
And what about cost overruns? With inflation, the cost to build could be way higher than they planned.
And that eats directly into margins and delays profitability. That's a real risk that could push that $26 target further out. You have to mention it.
That covers the internal risks. What about the external ones? The market still sees WULF as a crypto stock, right?
It does. And that brings us to the second risk, sector contagion.
Even with this great AI pivot story?
They're still tied to the crypto sector. The material points out that WULF has outperformed its mining peers, which is a great data point. But it doesn't make them immune.
So if Bitcoin's price collapses,
Investor sentiment for the whole sector could go sour, and that can affect WULF's stock price and its ability to raise capital, no matter how good their HPC contracts are.
so what's the concrete suggestion?
You need to at least try to quantify that exposure. Suggest estimating what percentage of the revenue still comes from Bitcoin mining today. Then you can discuss how a big drop in Bitcoin could impact them.
It shows you're thinking about the worst-case scenario.
It's compelling. The idea of going from a commodity Bitcoin miner to a key AI infrastructure player, that's a powerful narrative.
Especially with the nuclear power advantage.
But the narrative needs more grounding in the here and now. So the final point is this. The central thesis, the pivot of the decade, needs clearer and more present-day metrics defining the relative shift away from the legacy Bitcoin mining business towards high-performance computing dominance.
I see the weakness. It's in the financial firepower section. They do a great job highlighting the future. That $72.5 million in locked-in HPC revenue is huge.
And the $50.6 million in total Q3 revenue shows growth, but it's all blended together.
Right. They never break it down. They don't tell us what percentage of that current Q3 revenue actually came from HPC versus what came from mining Bitcoin.
And without that baseline, the pivot is just a story about the future. It's not a measurable trend that's happening right now.
The reader can't track the progress. Is this pivot 5% done or 35% done? That's a huge difference in conviction.
It's everything. So the suggestion is to weave that data right into the Q3 recap. Show the trajectory, make the pivot a tangible, ongoing process, not just a promise.
Show, don't just tell.
Exactly. And again, get specific. Within that financial section, explicitly state what portion of that $50 million in Q3 revenue was from HPC. If they can't break out revenue cleanly yet,
Then maybe talk about capital allocation.
perfect. Show the operational numbers. What's the current split between hashing capacity for Bitcoin versus deployed capacity for HPC? Show that the company's own resources are shifting away from mining and towards this new data infrastructure.
That makes the story real. And let's talk about that nuclear power angle for a second. That is their ultimate ace in the hole.
It is. It's their moat. But I think the piece could frame it even more powerfully.
How so?
Right now, the nuclear advantage section focuses a lot on how it benefits their mining operation. Cheap power equals cheap Bitcoin.
Which is an efficiency argument.
It's an efficiency argument, and those can be temporary. The real story here is scarcity.
It's about the zero-carbon baseload power. It's always on.
24/7. The big AI hyperscalers, your Amazons, your Microsofts, they're desperate for massive, reliable, and green power sources. They have ESG mandates to meet.
And you can't just go build a nuclear-powered data center campus overnight.
You can't. So the suggestion is to frame this nuclear advantage not just as a cost saving, but as a critical, non-replicable moat. It's what prevents a giant like AWS from just building their own competing facility next door.
So WULF isn't just a low-cost provider. They're a strategic partner with an indispensable asset.
Companies in the world. That's the narrative that justifies a premium valuation. That's the story that gets you to $26. The scarcity of that power source is the real story here.
Absolutely. These are fantastic points. I think with these three adjustments, this analysis goes from a strong retail piece to something that can stand up to serious institutional scrutiny. Let's quickly recap the actionable points for the listener.
Sounds good.
We covered three big areas today, all aimed at building that analytical credibility.
Right.
First, you have to tackle the dilution issue head-on. Integrate it into the capital cleanup story and frame it as a strategic trade-off that shows management's confidence and long-term vision.
Second, build that dedicated risk section. Don't shy away from it. Detail the execution risks tied to those 2026 revenue goals, and make sure to quantify the sector contagion risk from their remaining Bitcoin exposure.
And finally, sharpen that core pivot narrative. You need to give the reader clear present-day metrics. Show them exactly how much of the pivot of the decade has already happened.
I think implementing these steps will really elevate the material, making it feel more objective and ultimately more convincing for that sophisticated audience they're targeting.
I agree. It's a strong piece of work to begin with, and these changes will just make it that much more robust.
We really appreciate you sending the material in. When you've had a chance to revise it, please do send it back. We'd love to see it again.